Housing prices in the US and around the world have gone up like crazy in the past few years, especially since the pandemic has started over 2 years ago. You might be thinking the prices might start falling with the mortgage rates going up and with the talk about a coming recession. But I think the prices will continue to rise for some more time. The inventories are very low and it's taking longer than usual to construct houses, and there is a strong demand from the millennials. Another thing you might be wondering is it 2007 all over again? Are the housing prices about to crash again like they did in 2008? I think that is very unlikely. Credit standards in this cycle have been very high, and the general financial condition of home buyers is strong. So a repeat of 2007 is unlikely. But as you might expect, the housing market is slowing down. Housing prices and mortgage rates have been increasing. Housing prices in the US have increased by about 16% over the last year. And since the pandemic started, they've raised by a third almost. Mortgage rates, after reaching a low of 3.1% at the beginning of 2021, are now at 5.3%. This happened after Federal Reserve has raised its benchmark interest rate by 0.5% and indicated that it might do more such raises this year and the next one. At this rate, a borrower with a mortgage of $400,000 who used to pay about $1,900 a month at the end of last year now pays $2,500, which is 25% more. People are also losing appetite for real estate, especially in the US. According to a Gallup poll, only 30% of Americans think this is a good time to buy real estate. The lowest share since 1978, when Gallup started doing these surveys. Young people are especially pessimistic. Among those surveyed between 18 and 34 years, only 25% think this is a good time to buy into real estate. Buyers are adapting to raising interest rates in different ways. Some new buyers are surely being priced out of the market, but others are opting more for adjustable rate mortgages, which are cheaper in the long term but face the risk of higher interest rates in future. Such loans account for 10.8% according to the Mortgage Buyers Association, the highest such share since 2008. Applications for mortgages have reduced by 8% and the number of listings have reduced by 8.9% from February to April, according to Realtor.com. Though the housing market is clearly showing signs of slowing down, the prices are expected to continue to increase this year by as much as 15%. If you believe Zillow, the housing app. This is mostly because of millennials, those born in between 1981 and 1996, who are now reaching their peak home buying years. In America, millennials are the fastest growing home buying segment. They accounted for 50% of all the home loan applications over the past 2 years and accounted for as much as 60% of all the sales in the last year. Millennials make up the largest ever generation in America. In fact, more millennials are reaching the peak home buying age of 32 over the next years than ever before. This is also happening in other countries. In Britain, for instance, millennials are more likely to buy a house than rent one. In Canada, nearly half of the adults in between 25 and 35 have already purchased a property. To meet this demand, America needs 2 million new houses every year, according to Jefferies, an investment bank. For comparison, in 2021, there were 1.6 million new home starts in America. COVID has also had a lot of impact on the housing market. Ever since lockdowns began, millennials are buying larger family homes with a dedicated place to work from home. Those who already own a property are trading up. COVID has also nudged many Americans to bring forward their decision to buy a property. Millennials are also reshaping the US property market in two important ways. First, they are swapping their flats for family homes. A vast majority of young buyers in America have bought a single family home in 2021. Many of them are also leaving big expensive cities like the San Francisco area and New York City and flocking to Sunbelt areas like Phoenix and Tampa. With a growing number of millennials entering the market, the momentum in the housing market is likely to continue for some more time. Even if prices and demand begin to reach their upper limit in big expensive cities, due to strong demand from millennials and remote work, cheaper areas remain attractive and prices there could continue to rise for some more time. The big question now is housing affordability. Interest rates are going up everywhere. Federal Reserve is expected to increase interest rates by 6 more times this year. That could cool demand and increase the mortgage servicing costs. The current situation has an interesting historical parallel to 1980s. Raising interest rates in 1980s, for instance, cooled off the housing market just when baby boomers were reaching their peak home buying years. The big difference now is that interest rates are at a much lower level and they are expected to increase a lot less steeply. House building in rich countries has fallen. According to an analysis by The Economist magazine, 10 new houses were built per 1,000 people in 1960s. Now that number is half that, at 5. While it's become generally harder to build anything in America, COVID and the subsequent lockdowns has forced many construction companies to shut down. Even in places where stay-at-home mandates were milder and zoning laws are looser, like in Texas for instance, the increase in demand was so strong that builders could not keep up with it because of labor and material shortages. Builders are having to deal with high costs of materials such as steel, cement, lumber, copper, etc. And on many instances, these materials are just not available because of supply chain constraints. The construction industry is facing a huge labor shortage. Again, COVID and its subsequent lockdowns is a big reason for this, but even before COVID, the construction industry has been facing labor shortages because of long-standing issues. The average age of a construction worker is high. About 41% of all the construction workers in America are expected to retire in the next 10 years. Not enough young people are entering this industry. They don't think construction jobs are attractive enough or safe enough. Home builders are able to pass on these higher input costs to the customers. You can see this in the improved margins of home builders. For instance, D.R. Horton, the largest home builder in America, said the average sale price has increased by 14%, increasing its earnings by 78% in 2021. Some supply bottlenecks are beginning to ease and will continue to ease in future, but the number of new housing starts per person are much below the levels in early 2000. America and the other rich countries have a long way to go before their housing demand is met. According to Freddie Mac, which is a government-related company that offers mortgage loans to home buyers at subsidized rates, US is facing a shortage of 3.8 million homes in 2022. It's up from 2.5 million in 2018. According to some other estimates, the shortfall is as high as 5.5 million homes. Since the last boom in housing prices in 2007 was followed by a deep and painful recession, you might be wondering if history is about to repeat itself. Is it 2007 all over again now? The answer is no. It's very unlikely that housing prices will crash like they did in 2007, which is bad news if you are a home buyer. Compared with the past, the borrowers now are in a much better financial shape. Just a quarter of the mortgages originated between 2004 and 2007 were considered to be good. That is, having a credit score of above 760. About 12.5% of the borrowers were subprime, having a credit score of less than 620. In 2019, 60% of all the mortgage borrowers had a credit score of at least 760. During the COVID years, banks feared losses and raised the lending standards even more. In the first quarter of 2021, 73 80% of all the mortgage borrowers were considered very good, with a credit score of at least 760, and only 1.4% of the borrowers were considered subprime. The general financial condition of borrowers is also a lot healthier. That is one of the reasons why the housing markets have been resistant to the rising mortgage rates. Many Americans took advantage of low interest rates during the pandemic years and refinanced their home. About 70% of the borrowers now have mortgages with interest rates less than 4%. In 2018, just about 40% enjoyed such low borrowing costs. Americans also have a lot more wealth because of raising housing prices, at least on paper. And during the COVID years, because they couldn't go anywhere, they ended up saving all the money that they would have spent on travel. Maybe that is why 25% of all home sales are all cash transactions. That number was 20% before the pandemic, according to National Association of Realtors. Having said that, some buyers could go under if prices fall. The average loan to value ratio of a new mortgage in America is 83%, which is reasonable. So 83% is loan and 17% is out of pocket. The problem is that 83% is the average, and there are a lot of extremes in that. You probably know that if you pay 20% or more out of pocket, you don't have to buy private mortgage insurance. Only 40% of the borrowers have put up 20% or more out of pocket. Most of the rest, about 50% of the borrowers, have put up 10% or less of the home value. So those borrowers are under risk of going under if home prices starts falling. A lot of reckless lending happened to unreliable borrowers in mid-2000s. But now the story is very different. Large loans are being given to wealthy borrowers with long and strong credit histories in search of bigger family homes and larger workspaces. So in summary, after a crazy few years of raising home prices and now raising mortgage rates, the housing market is showing signs of cooling down. But because of low inventories and strong demand from millennials, the prices will continue to raise for some more time, especially in smaller and cheaper areas. Even if the prices fall, they are unlikely to crash. It will not be a repeat of 2007 again. I'm Sharat Mantravadi. Thanks for watching.